Welcome all to the node. I am Mike, aka Veteran Crypto, and sorry I was almost late. I was hard at work, finding sources that support what it is that we were wanting to talk about today. And this is something that we've talked about for probably 5 or 6 months now. Here on the channel and with our community, even back when we were DeFi crypto and airdrops, is how are these crypto assets, how are they going to be valued? You know, uh, um, Market cap is not an accurate measure to value these tokens and their price. Market cap is really just the amount of liquidity that people have invested in the token. That has no correlation to the underlying product or service or business that is that the token represents.
Well, yeah,
And
look at XRP. It's a big bag of shit, but it's got a $70 billion market cap.
yeah, basically retail, and for the most part, has invested $70 billion worth of their liquidity into a token that I mean, really doesn't do anything. It's a gas token. And that's true of like 99% of crypto. We always bash on XRP, and again, it's just because it's one of the largest market caps out there. It's the perfect example of a token that does not possess any of the trifecta that we've been teaching, and that is a real adoption. So, who has actually launched? You're always seeing posts, and we talked about this last night, and we're going to keep talking about it. You always see posts with hopium, that there's talks with, or as soon as this happens, the token's going to moon, all of those sorts of things. But real adoption, people, institutions going live with products and services that transact on the network that generate real fees and revenue. And if those fees and revenue actually translate over to you, the token holder, if the token that you are buying has actual value capture through programmatic buybacks and burns or other mechanisms. Because without that, like I always say, you're buying a meme coin. It doesn't matter what the company is doing. If there isn't value capture for you, the token holder, you are hoping for speculation. You're hoping for hype to increase mind share enough to get other people to FOMO in at a higher price so that you can sell and use them as exit liquidity. That's really and there's money to be made there. Don't get me wrong. But if you're wanting to invest long term, if you're looking for projects that are going to stand the test of time and be the next Google, the next Microsoft, you need to focus on the fundamentals. So, David, what's going on, brother? Let me mess with the chat for a bit while you give your 2 cents.
Sure. Let me just bring it back to maybe a real world example. Last night had some really interesting conversations with a bunch of different people at one of the haunts that I frequent down the street here in St. Pete Beach, and it's just so interesting to me how much stupid bullshit people believe. Like, it really is. Like, people believe a lot of stupid bullshit, man, and it's not just in crypto; it's in life in general. And so, I think part of the purpose of what we do here, Mike, is it's educating people, man. Like, you've got to be able to discern, the real from the fake. And unfortunately, in crypto, there's a lot of fakery out there. There's a lot of vaporware. Most crypto projects are still vapor because, look, it was our trifecta that has helped us to identify the projects that we think are going to perform well because they've got real value capture. But most projects don't. And most people continue to believe stuff that is just not true, man. Just not true. And, unfortunately, when it comes to investments, if you believe something that's not true, you're going to get wrecked. So, I see someone was posting in the chat that ADA was pumping today. And I was taking a look at ADA at 17 cents, Cardano, plus 2%. So I don't know that you would really call that a pump, but hey, I guess that's something to get excited about after down only for the last 5 years out of ADA.
Yeah.
So yeah, man, it's It's a real shame that so many people believe lies, believe stuff that's not true. And so if you want to educate yourself at the Node.pro, we give away all of the education. But if you want to support us, sign up for one of the premium products, man. $10 a month, something like that. You can support us by doing that. So what do you got here, Mike?
So chat is deceived. Okay. I want to point out, because we've started to see, we've gotten beat up pretty good over the past 5-6 months, and it's kind of refreshing to see.
You mean in crypto? In crypto.
It's a lot of communities have come after us, saying that what we've been saying is FUD. Whenever we've done our deep dives and we're using this value capture, and we're using a lot of these different points, because we didn't make up we did make up the trifecta, but we used it using traditional models. We used it how traditional finance values companies, and it's called P&E. So basically what it is I got it pulled up here, and I'll actually share it. Where are you at? Damn it! Did I freaking?
And who is this gentleman on the screen here who looks like he's about to fall asleep in that screenshot?
Oh, that's Rand. He's an interesting fellow. I wouldn't personally listen to a whole lot that he says. He's very entertaining, but he's wrong quite a bit, and has launched quite a few meme coins that didn't do anything, and and a lot of people in his community that kind of felt that buying them was going to make them rich, and and that's they're the ones that click the buttons. But let's see. Oh, here we go.
He kind of looks like a meme coin guy.
Damn it. For whatever reason. Oh, here we go. It's over here. All right. So this is how traditional finance is values businesses. It's the P&E ratio. So it's the current stock price and earnings per share. So basically, whatever the earnings were for that year, and it's divided by how many shares. So in crypto's case, it would be how many tokens. But that is a model based off of a security, which includes a legal contract between the stock purchaser and the company. Crypto does not have that. There was a whole court case with between Ripple and the SEC, where they determined that many crypto assets didn't pass the Howey test. So what we've been doing here on the channel is we are taking a similar model, and the way that we tweaked it was we looked at adoption. So that's the customer base. That is the institutions, the banks, the whatever that's building on the network. That is the customers that are purchasing the products and the services, and that generates revenue. If it's a business, they're charging for those fees, or they're charging for those products and services, and the fees and revenue that are accrued. If there is no value capture for the token, then the company keeps it all. That's theirs, because they have no legal obligation to share that with you, because these aren't securities. But if the token has value capture, then you, the token holder, through programmatic buybacks and burns like Hype and BNB and Tron and a lot of these other projects that use different mechanisms to share that revenue with token holders, then you, the token holder, share in those profits, that revenue and those fees. That is what we've been teaching here for 5 or 6 months, and now we're starting to see people chime in. We were kind of joking about it the other day that Discover Crypto, that they're starting to teach this in their new school. And this is something that I've been sharing with other content creators for a while, in personal chats and on our show, trying to tell them that this might not be the exact model, but this is going to be very close to how these institutions, and we have the receipts now. So even content creators, we'll play this real quick.
Bringing up Rand, I guess.
Oh yeah, sorry.
Liquidity, earn. Let's just let it finish.
Like our other equity in
State of the market. It tells you that we earnings. Do they understand what the protocol actually does? Right. That is what they're looking for. So in this new part of the market, basically, they are looking to investors are looking at crypto protocols the same way they look at companies. They say, what does this protocol service? What is the total addressable market? How does it actually make money? What service does this protocol actually derive or provide? How does it make money? And what they did then was they created this index. Now, we don't know what's in the index. We do know that there are 18 constituents, right? But we do know that all of them provide a certain kind of service. They'll end up making money in a very simple way, and you can understand how they actually land up making money. So that narrows down the protocols to, I don't know, maybe like, in fact, let's look at a better picture here. But these are the crypto protocols that are actually making money. So it's like,
so it's kind of funny. Like look at these projects. So Kenton, Hyperliquid, Pump. We did a deep dive on that. You can't see some of these other ones, but if you come here again, Hyperliquid, Pump, Sky, Aerodrome, Jupiter. A lot of these are ones that we've identified.
Yeah, but those Aerodrome numbers, man, that's not real. Those are not real. Swap
I know you like to say that, but you've never presented any evidence to prove that is not the case.
Yes, I do. So
cite your sources.
I'll tell you. So when you provide liquidity and your liquidity is used to facilitate swaps, those swaps, that's not protocol revenue. That is not protocol revenue.
So
Aerodrome
how is that different than Hype?
Well, because Hype, when you are trading on Hyperliquid, and there are fees generated by the protocol when you trade, that's revenue. But that's much different.
Fees generated on Hype are the same as fees generated in 100% of them are either go back to the VE Aero lock holders or are max locked or burned.
It's not the same.
It is exactly the same.
Not even close.
It is 100% exactly the same.
Not even close.
And until you can present real evidence and cited sources and numbers saying different, you're wrong.
Well, I just told you. So when you provide liquidity and your liquidity is used to facilitate swaps, and there's a fee generated right there. When a swap is facilitated using your liquidity, that fee is not protocol revenue.
It doesn't matter what you define it as. It matters that those fees are earned, that those fees are taken out of circulation.
That's not what happens on Aerodrome.
That's exactly what happens on Aerodrome.
No, it's not.
Yes, it is. You really need to go through our deep dive, brother, because it's exactly what you can
not what it is, brother.
Dude. I mean, it's the chat even agrees. Fees are fees. If the protocol is generating fees and those fees go to reducing the token supply, same.
But different. Same, but different.
It's not different. It's exactly the same. Both of those protocols do the exact same thing.
No, they don't. Not even close.
Getting on a rabbit trail. So all of these different protocols, we've identified many of them as meeting our trifecta, and we've been saying this for many months now, and gotten beat up in crypto about it. So there's also this, and this is what Rand was just talking about, is Pantera Capital. They came out and said exactly what it is and why they didn't include Bitcoin or XRP in this.
Yeah, I don't think that Bitcoin meets our trifecta. It doesn't.
It doesn't.
It doesn't.
And that's why they didn't include it. So this is a fund, and this is the CEO of Pantera Capital. So let's see what she has to say.
Oh, who is it?
Sorry. I keep on not sharing the tab. So let's do this. All right, let's start again.
Solana, Tron, and Hyperliquid. So what are the required Experiments, how much turnover do you expect, and what do these choices represent?
Yeah, so let's just admit that digital assets moves faster than equity assets, for example. But what we're
So the lady
same
who's
sort of
speaking here, she
principles that we
is.
have in our equity indices into digital assets. So when you think about the seasoning period, the revenue generation, the listing requirement, the liquidity behind these different protocols for these tokens, these are the things that we think matter for serious investors and asset managers in the digital asset space. And so we think because there's this likeness between what we deliver in equity indices and into this new benchmark for digital assets, we think it'll make sense for the investing public.
So this is what sorry the connection for whatever reason on that video was a little choppy, but basically what she's saying is what we've been saying here for quite some time is they don't care if something is getting a bunch of mind share on social media. They don't care what retail cares about. Traditionally, back through past cycles, everything was narratives. Everyone was trying to figure out what the next hot narrative was going to be so that they could front run it. Everyone was wanting to buy the rumor, sell the news. Everything was speculative. It was a speculative market. We're moving into a utility market, and this is something that I've been saying for a couple of years now. Is and I've gotten laughed at for it. That we eventually that we were going to move into a utility market where none of this retail speculation was going to it wasn't going to be as weighted as heavily for these assets, and a lot of these assets were going to go away. And I got laughed at for it, but
You were right.
Yeah. And
Yeah.
David, when he started working with us, he's the one that came up with the trifecta, basically, because it changed the way that I further changed the way that I look at these assets. I only invest in projects that I feel like have solid value capture. But David, what do you think?
Sure. So what I think is that if I'm a liquidity provider, okay, and I provide my liquidity to a pool in two assets, let's say it's Arrow and USDC. I provide that liquidity to a pool. My liquidity is used to facilitate a trade, facilitate a swap. I, as the LP, earn that swap fee. The protocol, that is not protocol revenue. If I'm trading on Hyperliquid, however,
are you getting back on that rabbit trail again?
Well, because you got to understand value capture, and Aerodrome doesn't have it.
Well,
so
keep making statements, but you've never presented any facts that show how they are different.
I just did.
You didn't.
Okay, so let me restate it. So when I'm an LP on Aerodrome or any liquidity provision decentralized exchange, and I have two tokens, let's say that it's
that has nothing to do with what we're talking about.
It's value. We're talking about value capture.
You are trying to define revenue again. I'm talking about fees generated on a protocol. I don't care if it's swaps. I don't care if it's trading fees. I don't care what it is. It's the fees and the revenue. This is our trifecta, brother. If it generates fees and revenue, what happens to that fees and revenue? Does the protocol keep it, or through some mechanism, is it shared with token holders through value capture?
That's a great point. That's a great point.
If those fees and revenue either go back, to a programmatic buyback and burn like Hype, or if it goes, to where it pays token holders that are holding the asset, locking the asset, providing liquidity, and also if it is programmatically locking anything that doesn't go out to that permanently and taking those tokens out of circulation. It is the same as a burn.
So what do you think about Pump? We ran some deep dive research on the pump.fund protocol the other week. And, if we're talking about value capture, that pump.fund protocol, dude, that protocol generates like $7 million a week in fees. Yeah. But where do those fees go? Are those fees used to buy back and burn the pump token? Is there a legit value accrual mechanism for the pump token? I think that our deep dive research showed us that that value accrual mechanism for the pump token is pretty broken. And we've got that in the Intel library, that deep dive research on pump.
But that's a whole different story, because the token lacks value capture. Whereas I've repeatedly stated how Arrow does have value capture.
I don't think it does.
You don't think it does? I have actual documentation. I can cite sources that show otherwise.
Well, then you should do that, because I don't think it does. And what do we know about
research in our Intel library that supports?
Did we run deep dive research on Aerodrome?
We did, and
we did.
I need to rerun it with the new focus on the tokenomics. But I am knowledgeable enough about Aerodrome that everything that I stated, where the fees go, is 100% factual, and that is value capture.
I don't know that the Arrow token actually has any value capture.
I've repeatedly, very simply stated exactly how it has value capture.
I think that there might be a little bit of a misunderstanding.
Are directly shared with token holders that lock Arrow, and it also, anything that doesn't go to that, it buys the Arrow token and permanently takes it out of circulation.
I don't know that that's true either.
It's 100% true.
And what's up with those new tokenomics for Aerodrome? When are we
going
to get
we don't know yet, but
visibility into that?
You're on the node. We state things as they currently are. We don't speculate. So yes, I'm very interested, and I'm pissed off that they just kind of nonchalantly, we're launching in September now and not July, on some obscure little post. I'm not excited about that.
Me neither. I don't like that. They need to be more transparent about exactly what's going on there.
Yes, I agree with that. But again, facts, logic, reason, unemotional.
We're just having a discussion. And Aerodrome sucks.
That's your opinion. That's your personal feelings. And
I understand liquidity provision extremely well.
I don't invest in feelings. I invest in facts, fundamentals, and
I would love to see Aerodrome succeed. I just I don't believe that the Aerodrome protocol, because you brought up, Mike, earlier, that list, because I've seen that list all over X over the last week or two, that list of protocols. And Aerodrome is on that list, I believe, erroneously. Aerodrome did not generate $375 million in fees.
You believe?
Yeah, well, because
that's
it
just
didn't.
Like the XRP folks, brother.
Okay, why don't we bring it on over to DeFi Llama? What does DeFi Llama say about Aerodrome's income statement? If we take a look at DeFi Llama,
we can loop back to that. I don't want to get on rabbit trails. It always gets us off the topic. I want to make sure we get the information out. But
I don't know, man.
We've done this multiple times, and
why can't you get it, Mike? Why can't you get it, bro?
Because you're wrong.
I think you're wrong.
Well, you think I'm wrong, but I've actually shown.
No, I know you're wrong.
I've actually shown documentation that shows I'm right. And I have also
let's agree that we disagree and that you're wrong.
I also have all of my statements where every week I earn free Arrow, and the documentation shows
not free
that they 100%. Then what do you call hype?
So hype, if I'm trading on a perps dex and there are fees generated when I trade,
you're going to talk about it being revenue and all that.
That's revenue,
but
that's protocol revenue.
That has nothing to do with the value capture. If the protocol generates fees and revenue. The definition of revenue has nothing to do with it if it has value accrual or
not. Yeah, those things are different. They're definitely different. That's for sure. Yeah. It's just that understanding the difference between a swap fee generated as a result of liquidity being used to facilitate a trade, that fee that's generated there that goes back to LPs, that is different than a transaction fee generated on a perps dex, which then accrues to a token.
I agree with that, but it's still a fee that's paid to the protocol. And if that fee somehow makes its way to the token holder, through value capture, same.
But different. And I'm looking at the income statement for Aerodrome. It does not
I will
look
agree.
good.
The fee is generated differently, but what is
And
done
that's
with
the
that
point.
fee is not the same, or is the same.
It's not. And
It
you know,
is.
when I'm looking at the income statement for Aerodrome, and we don't have to keep talking about this if you don't want to, Mike, but the income statement for Aerodrome, and anyone is free to take a look at this. It's over on DeFi Llama. If you type in Aerodrome on DeFi Llama and you take a look at the income statement, it's right there on the main page for Aerodrome. And for most protocols in crypto now on DeFi Llama, you can take a look at the income statement. Aerodrome's income statement looks like dog shit because fees generated as a result of liquidity being used to facilitate a swap, those fees are not protocol revenue.
Because
it on
because
their income statement.
100% of the fees go to token holders.
Yeah, and that's a Fugazi. That's the problem with the VE33 tokenomics. It's
But-
Fugazinomics. That's a
but-
great term, Fugazinomics. We got to coin that, man.
It's I could not disagree more. But all right,
Fair. That's fair.
99%
We can-
of the
we can
time,
have a-
I fully
we can have a
admit that
disagreement.
David
That's for
is
sure.
right. But on this point, I will adamantly disagree because I am very, very knowledgeable about Aerodrome, and there is literally other than the way that the fee is generated on the different platforms, there is no difference. Well, I won't say no difference because on Hype, it just there is no locks and stuff like that. 100% of the fees and revenue go to buying back and burning the token. Aerodrome, it's split between going to the locks and being max locked, and so there are some nuanced difference, but the underlying mechanism is the same. That all of the fees and revenue generated by the platform are shared with token holders in some way.
Yeah. I'm looking at the income statement for Aerodrome. Not too good. But what do you got going here? Valuation comparison, Ethereum versus Avalanche. What's going on with this?
So not necessarily these assets in particular, but this is a digital asset investing from Arca Finance, how to value crypto assets. And so what they have highlighted is a lot of the points that we make in the trifecta. It talks about fees generated, the sales revenue. It talks about the protocol revenue, the gross profit, the net burn, the net burn per token, these growth metrics, so year over year, what is the the customer growth, things like that. So that's the adoption factor, the fees and revenue, and then how does that the fees and revenue potentially make it back to us, the token holders? Because again, if there is no mechanism to share those fees and revenue with us, we're buying a football jersey of our favorite team. We're buying the baseball card. We're buying the little flag that we can wave. Cheering them on. Really.
I think that people are moving away from that. People don't want to hold a meme, of their favorite protocol. They don't want that. People want real utility, real value capture. There needs to be real users, real user growth on the protocol. And those users need to drive real revenues. And those revenues need to accrue to token holders. That's the trifecta. And, I think we ran deep dive research on Avalanche also.
We have
in the Intel library. And unfortunately, the value capture mechanism for Avalanche seems to be quite broken.
Yeah, I was not impressed. And to be fair, again, 95% or more of crypto projects lack, any real value capture. Today we're going to be going over Lorenzo and Caspa, but we've gone over Quant. A lot of these, kind of higher market cap, Dino coins, the ISO tokens, some new ones, Robinhood Chain, there is no token, but we did a deep dive on that. Maple Finance, here's Pump Fun, Kronos, Binance, Polkadot, Avalanche, Algorand, Plume. We've done all of these. And if you want to go in here, this is 100% free. You can watch these, and each one is about a 15-minute investment of your time. But you're going to come out of it having a solid, basic understanding about what it is that they are trying to address. The pain point, the use case they're trying to address, the token, the tokenomics, if it has value capture or not. And the great thing about this is what we stress here, on the node, is citing your sources. So if you come into here, you have just a quick 8 to 10 minute video. You can read through a lot of the information, depending on how you absorb information. A slide deck, PowerPoint presentation, basically a elevator pitch. It's the infographic, and the most important document is this, the source document. This is what we build it all off of. And if you scroll to the bottom, there'll be cited sources. Some of our older ones,
maybe that one's not the best example. That was domination finance.
Yeah, I need to go through and redo some of these. But
how about take a look at Caspa, the one that we're going to be running through today? Because for me, I always thought that Caspa was an interesting protocol, but we're going to learn about whether there's actual value capture there or not today.
Well, here's one we did yesterday. Quant, but at the end of the source document, we cite all of our sources. Here at the node, we do not invest based off of feelings or speculation or ifs or maybes. We invest off of what the way that things currently are. What partnerships, not even partnerships, who has actually built and gone live, who is paying fees and revenue to the chain for their products and services. Us, the token holder, is there a mechanism for us to benefit or profit directly from those fees and revenue? And we cite all of our sources on how we come up with, because most of our content is focused on those aspects, our trifecta. And so we make sure that we cite our sources. So if you come at us, if we do a deep dive on your project that you're bullish on, I know that a lot of people get emotional and they think that people are fudding their project and they want to come after people for that they think are fudding their project. But pump the brakes, look at the cited sources.
And Cass wants attention.
She does. Look at the cited sources, and if you feel like we got something wrong, by all means, we are open to being wrong. We welcome it here. We like opposing views. How me and David were just going back and forth. That's how me and David are.
That's what you have to be able to do. You got to be able to have a conversation about this stuff.
Yes.
You got to seek truth.
Yes.
And look, Mike can be wrong all day.
As could David.
Look, I can be wrong too. But the thing is, though, is that we seek truth. Yeah. We want to be proven wrong. Look, if you've got a hypothesis, you need to try to disprove your hypothesis. Otherwise, you might just get stuck holding a bag of dog shit and get wrecked. So you got to be careful out there. You got to seek truth. You got to find as much information as you possibly can, especially about these coins and tokens, because a lot of these tokenomics, man, are extremely complex.
Yeah.
And I think that
one yesterday.
Dude, I couldn't really, to be completely honest, Mike, I couldn't make heads or tails of either of those.
I couldn't follow Cubic. The tokenomics on it, and when it was talking about like how it had value cap, I was fucking lost, dude.
Dude, I was too. I was too. Like, and look, we do this for a living, man. Like we do this stuff for a living, and I literally couldn't make heads or tails of either of those protocols, man. And one of them, and I don't remember which one, like Quant, Cubic, I kept getting them confused. But when we were taking a look at the protocol's website, that website had all the hallmarks of a scam, all of them, so, and there are some pretty clear hallmarks of scam protocols in crypto.
Crypto Steve-O says it perfectly. If it doesn't make sense, it's usually garbage.
Exactly. It should be simple.
Yeah. It shouldn't be complex. If they can't explain very simply, what it is that they're doing and, the token and the tokenomics and things like that, then usually it's word salad. Usually it's the same thing that we see with a lot of content creators. They use a lot of words and a lot of emotion, and talk in circles, and deal in hypotheticals and things like that, because it's easy to paint a bullish picture for something if you're just talking about, well, maybe, or if this happens, then yeah, the token could go to $10,000. It's like, yeah, when you're dealing in emotion and what ifs, anything's possible. That's why we focus on real fundamentals here. What is the current state of these projects? If you want to speculate, that's on you. If you want to do more research and you want to go deeper, and you want to think that, well, if this happens and maybe this, and you want to go higher up the risk profile, that's on you. We're not here to influence anybody. We're here to
Mike, you know what I'd be really curious to take a look at again? Can you bring up that list that shows all those coins that generate, where the protocol generates a ton of revenue? Because we've run enough deep dive research at this point where I think that we can speak intelligently to the revenues that are generated by all of those protocols. I think at the top of the list was Tether, and that makes sense.
There we go.
Because so let's take a look at this again. There we go. Awesome. So Tether at the top of the list. And look, that makes a ton of sense, right? So the reason why Tether and Circle are at the top of that list is they hold treasuries. And that yield on those US treasuries that they hold, by law, they cannot pass that yield on to token holders. And so they earn it. And they are extremely profitable businesses. I mean, Tether, how many employees?
Why do you think the banks came up with OUSD? Look at
this.
Tether's making a 0.23 billion in 2 years. Circle has made 4.16 billion. Banks don't want to use them. They want to keep that revenue.
Right.
They want to keep that 4 to 5% on the those treasuries that they have to keep. Because that's what the Genius Act was, is they have to be backed 1-to-1 by the US dollar or US dollar equivalent. They're going to buy treasuries. And that's why the US government did it, is it forces these stable coins to be compliant in the US to buy treasuries, to buy the US's debt. And they want to earn that 4 to 5%. They're not going to give that to Tether and Circle. They want to keep that for themselves.
I'm really curious to see, how quickly we see adoption for OUSD, from retail. I think that might get adopted extremely quickly. So, Tether and Circle, they've got their work cut out for them to be able to compete with OUSD when that product really launches. And isn't Tether going to get audited, or they're auditing themselves?
They were self-auditing and making a big deal of it, and then it just went radio silent. They were like, we have this organization, and this organization, and this organization, and they're coming in and they're going to do an audit. And it was a couple
just kidding. Look over there. It's a Wookiee.
Yeah, it's a Wookiee. Chewbacca is a Wookiee. No, that's exactly what happened.
Don't worry about that audit. You don't need to worry about all that.
Just ninja vanished.
I know, man. But, at the same time, though, Tether, I'm pretty sure that Tether per employee is the most profitable company on the planet per employee. Because they've got they've got like 10 employees or something like that.
They actually recently hired, I think they have like 50 now or something like that, but still, when you're making $11.23 billion in 2 years and you have 50 employees.
They make a killing because by law, they are not allowed to pass on any of that yield to USDT token holders.
Yep.
So how does that make you feel if you hold USDT? And also, how does it make you feel knowing that your USDT or USDC can be frozen at any time?
We saw that with Aave.
Well, so what happened with Aave was a little bit different than, so if you've got, let's say that you deposit USDT or USDC into a vault on Aave V3, and then that vault utilization goes to 100% and you can no longer withdraw your USDC or USDT. Well, I
don't mean that Aave froze it, but in that whole, freaking debacle, some of the assets that
the people ETH markets.
Well, it was ETH, but they had swapped it out of ETH into some USDC or USDT, and USDC and Circle and Tether actually ended up freezing some of those assets and was able to recover some. And also in that exploit that happened right after that, It was something DAO, I think.
I mean, look. So when it comes to the freezing of these stablecoin assets,
CBDCs.
right? That's the problem, man. People are so concerned about CBDCs, but we've already got them. This legislation in the United States, the Genius Act, and it looks like
MICA.
maybe MICA too. Yeah, that's in the EU.
Yep.
The communist authoritarian regime over there in the EU, that MICA legislation. But look, man, like if you hold a stablecoin product and that product can be frozen at any time, well, then what's the difference between that and a legit CBDC issued by a central bank? I don't think that there's really a whole lot of a difference. Not much of a difference, So, yeah, I think that we should probably run some deep dive research at some point over the next couple of weeks on the best decentralized stablecoin products, and I think we already have. And we ran through Bold. Yeah, Bold is an interesting one because that's a real decentralized stablecoin product. It's quite a bit different than USDC and USDT. It's not backed by US treasuries at all. In fact, it's backed by Ethereum. So kind of an interesting product there, truly decentralized, can't be frozen.
Did
but
we ever
you
do
can.
Bold?
I thought that we might have.
I
Maybe.
don't see it. I'm going to make a note of it just so I can make sure.
It was liquidity. We did. Yeah.
Oh, we did. Okay. Yeah. Liquidity.
So liquidity. So the liquidity protocol, when you deposit ETH and then you mint that Bold stablecoin, it's a form of leverage. And so that means that you can, the correct terminology there is not get liquidated, you can get redeemed against. And so you've got to just keep that in mind. But the thing about Bold, that stablecoin product, is that it's truly decentralized. And so that means that you can hold a stablecoin pegged to one without having to worry about it suddenly being frozen out from under you. So that's pretty cool. I like that. And there are very, very few of these stablecoin products that can't be frozen, So DeFi definitely is loaded with CBDCs now.
Well, Crypto Stevo, valid point. What happens to that stable coin if ETH tanks?
So you would continue to hold it. If you've got that stable coin in your wallet, you own that stable coin product. But that ETH that you deposited into the liquidity protocol, that ETH can get redeemed against. So you could essentially lose your ETH. And so you just got to keep that in mind. But liquidity is a very interesting protocol. I like it quite a bit. And I can't say that there are many other truly decentralized stablecoin products out there. There really aren't. I think there's like Frax USD. That's one of them.
Yeah.
But small TVLs for those things.
Well, for that matter, there's not a whole lot of truly decentralized projects in general. Truly decentralized. And I'm not a big fan of DAOs. I mean, it's really hard for me to find anything that that I'm bullish on that's decentralized, because I'm not a big fan of DAOs. Because let's be honest, most retail are idiots, and I don't want a bunch. It's the same thing as politics. I don't want a pure democracy. Because the majority of people aren't educated. They don't understand. That certain aspects. I won't go down that rabbit hole, but I don't want a bunch of people who don't understand the tech, that don't understand the best way forward. I want the smartest minds deciding what to do with a company. That's why I would invest in Tesla, or I would invest in SpaceX or something, because Musk has shown he is able to form successful teams and accomplish freaking amazing feats in a very short period of time. I'm investing in Elon Musk, in the teams that he puts together, if I'm investing in these, in those assets. It's the same thing with crypto. I'm investing in the team. I'm investing in what they're able to accomplish. Who are they able to sell their products and services to? How are they able to get that adoption? The fees and revenue, because of the adoption. Have they built it in a way to where, it maximizes the fees and revenue generated? And did they build out the token to where it has the tokenomics, to where, the token has value capture, to where we, the token holders, benefit? Because if at any point, in that trifecta, it breaks down. If you don't have the adoption, the other two don't matter. If you don't have the adoption and the fees, it doesn't matter how much value capture the token has. It has to have all three or you have nothing.
You know what we're also starting to see here, Mike? We're starting to see many of these protocols slowly die or quickly die because, a lot of them have this flywheel where they mint these tokens in order to incentivize validators to secure the network. And when that mechanism breaks, well, then the chain goes bye-bye or the protocol goes bye-bye. So, we saw that recently, not exactly this mechanism, but, over the last year, we've seen
We've seen a bunch. We've seen
a lot of protocols and chains go bye-bye because, hey, if there's no users on the protocol or the chain and those users don't drive revenue and those revenues don't accrue to the product, the protocol, token, chain, whatever, then, no reason for it to exist. And, when it comes to decentralized protocols, truly decentralized protocols, I think that there's, maybe two. That's it.
Yeah.
I think it's basically Bitcoin. And I think that you could throw Monero in there simply because I do think that it is extremely decentralized. I believe that there are more validators, more people running nodes for Monero than there are even for Bitcoin. So pretty sure that Monero is quite decentralized. I would even categorize that one as a decentralized commodity. But, how many others exist like that? It's Bitcoin, it's Monero, and I think that's basically it. Like truly decentralized protocols, I think it's just those two. And, Bitcoin is the best of them, but Bitcoin doesn't meet our trifecta, though. There really isn't a legitimate value capture mechanism for Bitcoin. If you're holding Bitcoin, what are you really holding? A lot of people say it's a pet rock. And look, I love Bitcoin. I do. But right now, it kind of is a bit of a pet rock.
I hear this quite a bit. What's your thoughts on? To be honest, I don't have thoughts on it because haven't really researched it, but I've heard of this, the Nakamoto coefficient.
Good question. That's a decentralization measure. I believe that is a decentralization measure.
That's about my extent of my knowledge on it.
Yeah, let's see. Tell me about the Nakamoto coefficient. Let's see.
So while you're looking that up, I mean, to be fair, a lot of the projects that we're bullish on, or that I'm bullish on, here on the node, the tokenomics can work in reverse. Hype. If users went down, so those fees and revenue went down, that programmatic buyback and burn, the token can flip inflationary. Same thing can happen with Aerodrome. If it stops earning fees, I stop earning with my locks. Those max locks that they do to take tokens out of circulation, that ceases. But those tokens keep getting generated. So it's important to understand the tokenomics of these different projects, and as long as you do, you do you. But I highly suggest that you invest off more than social media posts and emotion, and a 1 day pump. Going to CoinMarketCap and seeing that a token pumped 20% today isn't necessarily a good thing to be like, okay, now I'm going to FOMO into that.
Yeah, in fact, you really can't buy big green candles like that. You got to be careful of that, buying after a token makes a move. So this Nakamoto coefficient, it looks like there's a couple of items here. Number one, consensus control. So that's mining or staking. What mechanism does the protocol use? Is it proof of work? So how many distinct mining pools are needed to reach 51% of the total hash rate? Or is it proof of stake? How many validators control enough total staked tokens to either halt or manipulate the consensus mechanism? The second item here is developer and governance concentration. So how many core developers write the vast majority of code commits or control the primary GitHub repos? The third item here, and there's only two more. The third item is client software diversity. So how many different software clients run the network? If 80% of nodes run a single client software, well, then a bug in that software could crash the entire network, making the client coefficient effectively 1. And then the last item here is infrastructure and hosting. So how many cloud providers, like for example, Amazon Web Services or Google Cloud, are used to host that node infrastructure? If there are 3 cloud providers that host over half the nodes, then if those 3 companies, if they decide to take those nodes offline, that would potentially disrupt the network. So the Nakamoto coefficient is, typically used to determine how decentralized a protocol is based off of consensus control, developer and governance concentration, client software diversity, and infrastructure and hosting. Those are the 4 items.
So this right here is chain spec. So Steve-O in the chat, told me to take a look at it. It says most decentralized blockchains by the Nakamoto coefficient. Polkadot is the top one, and then you got Ton, Avalanche, Sui, Solana, Cardano, ICP, Aptos. Why is Tron? Tron, Tezos, Algorand. I feel like this isn't showing all of the different projects, and I'd be curious to find out what they're looking at.
Yeah, so Polkadot looks like a dying project to me.
Yeah, but I mean
yeah,
that doesn't take anything away from its potential of scoring high on the Nakamoto coefficient. It being
true,
decentralized.
true, very true.
Yeah.
Uh,
I'm definitely not saying because it has a high Nakamoto coefficient. I'm not saying go buy it. I'm just we're talking about decentralization.
Yeah, so if we're just taking a look at DOT for a second, Polkadot, I mean, dude, how hot was that token last, actually 2 bull markets ago? This is one of those dino coins.
Yeah.
Just over the last 12 months, the DOT token is down a whopping 93%. So just because something is cheap does not make it a good buy. So yeah, I would pass on DOT. That's for sure.
Yeah, I would definitely agree with that. So blockchain financials. There's some interesting data here. Of course, you want to dig pretty deep and just make sure that you verify where they get their data from. But Tron, from chain revenue, this is this is looking pretty accurate. And again, this isn't all protocols. This isn't all dexes and things like that. But still, interesting to look at. You got Solana, Ethereum, BNB, Bitcoin, Polygon, Base, Arbitrum. So a lot of this average transaction fees, fully diluted value, chain revenue, switch to chain to native token. Okay, all right. Red belly, interesting. Now there's some interesting information here.
Yeah, so I think, did we run a deep dive research on Tron? Pretty sure that we did.
We did.
Yeah, so legit value capture mechanism there. That's for sure.
Yeah. No, absolutely. I'm actually very bullish on Tron. It's not where it's used most is Southeast Asia for stable coins for the most part. But again, that is a very solid use case, and it's it's not cornered that market, but it definitely
I
has.
think it kind of has.
Well, it has the market share. It has the
I
market
think
share.
that Tether in Southeast Asia and Latin America owns that market. And, Tether has, for all intents and purposes, been forced to exit the European market simply because it's not MiCA compliant.
Yep.
So,
I mean, he got pulled off Binance, and and that was the stable coin for Binance. So not all of Binance, but like the European Binance, because they have
Binance lost their access to the European markets too.
Yeah.
That's a shame, man. They've got politicians over there who don't have the interests of their constituent citizens in mind, I would say.
I have my personal feelings about Binance, and we've talked about
Me
it
too.
before. Yeah, like October 10th, and a lot of the shenanigans that went down, and a lot of it had to do with Binance, the platform, and not saying it was malicious on their part. I have no evidence of that,
Certainly looked like it, though.
but
From an outsider's perspective, it did.
it was a lot of the issues were very focused on that occurred only on that platform.
It was Binance's margining system. It looked to me like it was a direct attack on Binance's margining system. Now, whether that was done by, I don't know who it was done by, but it definitely succeeded because we saw 3 pieces of collateral in Binance's margining system depeg. It was USDE, the Athena stablecoin product, an algorithmic stablecoin. It was a form of BNB collateral and a form of ETH collateral. Those 3 pieces of collateral depegged. And if you're holding ETH or BNB or USDE in your margin account on Binance, and let's say that you're engaged in trading activity and you're using leverage and your margin suddenly gets cut by 50%, well, whatever trade you're in is going to get forced closed, even if it's profitable. So, that's basically what happened on Binance, and then it cascaded onto Hyperliquid. So, we saw massive liquidations. Mike, there were like 2,000 accounts on October 10th that went to zero. Can you imagine that?
A lot of people's stop losses didn't trigger.
That too.
They had stop losses in, and they didn't freaking trigger. And
So here's something you got to ask yourself, because on ETH mainnet and on the layer 2s on October 10th, if there's significant transaction volume and ETH mainnet, for all intents and purposes, ceases to function because it's just too slow, you can't get transactions executed quickly enough, or on a layer 2 chain like Arbitrum, for example, transactions just did not execute at all. Well, then, if you're going to have a plus or minus 20% move in ETH, the underlying asset for that entire ecosystem, and it forces the chains to stop working, then is Ethereum and its layer 2 chains, are they actually ready for prime time? I don't think so, man. Like, if you're going to see a plus or minus 20% day on, for ETH, and then the chains stop working, then it's just not ready for prime time. So, yeah, that's a shame. Need to fix that.
Yeah, no, absolutely. Well, I mean, we've reached the halfway mark. Do you want to jump into the deep dives, or?
I kind of want to talk some more shit about Aerodrome. How do you feel about that?
I'm sure you do.
I do. Depends on what your definition of is.
That's right, Bill Clinton. All right.
Okay, so Caspa. Why don't we start with Caspa? I'm really excited for this one because I like Caspa, but I don't know why I like Caspa.
I don't know.
So here's the reason why. So when I was mining ETH back in 2017 and early 2018, I believe it was 2018. So if we take a look here at Caspa, I'm going to go ahead and bring up just a chart of Caspa real quick. I remember when I was mining ETH, when ETH flipped, when there was that merge and it went from proof of work to proof of stake, all of a sudden, all those guys who had these GPU mining rigs, they had to find something else to mine. And so there were a lot of guys on YouTube who were putting out content about mining, and they suddenly started mining Caspa. And so if we just zoom out in time here, let me see if I can get all the data. This only goes back to 2022. Let's see if I can find all the data for Caspa, just so that we can take a look at this thing. Caspa, there we go. How about spot crypto? This should work. Awesome. So just taking a look at this chart real quick for Caspa, all the way, this only goes back to 2022 also. I know that this coin has a longer history than that, but in 2022, this thing was trading for a fraction of a penny. It looks like 3/1000ths or 3/300ths of a cent. And at its all-time high, it rallied all the way up to 20 cents a little bit more than 20 cents. So this pattern here, this massive move to the upside, and then giving almost all of it back. I liked Caspa for the proof of work mining infrastructure. I liked that. But I don't really know a whole lot about the protocol itself. So let's go ahead and let's run this deep dive research and let's learn about Caspa.
The physical limit of the Caspa network is defined by its directed acyclic graph, or block DAG, running at exactly 10 blocks per second. For years, this architecture served one highly specific purpose: executing a payments-focused base layer with maximum efficiency. The system accepted simultaneous blocks, ordered them, and integrated them into a single high-speed ledger. Introducing smart contracts to a network requires managing complex state changes, a task that traditional platforms like the Ethereum virtual machine handle through a singular global state model. Every node agrees on a single snapshot of the entire network at a specific moment in time. Enforcing a global state model on a block DAG producing 10 blocks a second creates an immediate physical contradiction. Serializing every transaction to update a single global database introduces severe validation bottlenecks, completely destroying the speed advantage of parallel block production.
Okay, so all it's doing here is describing the consensus mechanism.
To build a programmable execution layer on top of Caspa, developers had to reject the global state model entirely. The network required a localized approach to smart contracts, one that could operate independently alongside thousands of competing transactions without waiting in a single file line. On June 30th, 2026, at the deterministic decentralized association activation score of 474,165,565, the Caspa mainnet crossed this threshold. This event, known as the Toccata hard fork, triggered a complete rewrite of Caspa's consensus rules. Toccata deployed as a unified consensus bundle of 4 distinct Caspa improvement proposals, or KIPs. These proposals systematically rebuilt how the network processes script execution, handles cryptographic proof verification, and enforces state transition limits across the DAG. By integrating these specific upgrades, Toccata transitioned Caspa from a simple transaction ledger into an expressive financial settlement layer, all while maintaining its underlying proof-of-work security and high-frequency parallelism. This diagram illustrates the UTXO model, an isolated container for a digital asset. KIP 17 introduces covenant bindings. This outer ring locks on to the UTXO, applying a localized contract. To satisfy it, the original node divides into an identically locked successor. A highly active contract generates a massive lineage of previous UTXOs. Recursively tracing this history would crash the validation engine. KIP 20 solves this bottleneck with a persistent 32-byte identifier. This hex code string stamps across the continuous chain, linking the entire UTXO family. This single identifier gives the consensus engine exactly what it needs. It can validate the state transition instantly by confirming the UTXO path, completely eliminating the need to look backward through historical block data. Localized covenant rules combined with instant lineage verification allow highly complex smart contracts to execute independently. Because they do not require global state updates, these contracts run precisely as fast as the network's parallel architecture allows.
So this was the thing that so many people were excited about for Caspa, was the ability to run smart contracts on Caspa.
Even with localized covenants, certain operations, like decentralized rollups and enterprise compliance protocols, are too computationally heavy to run directly on the base layer. They require execution to happen entirely off-chain. KIP 16 bridges this gap. It introduces specific ZK precompile opcodes that allow these off-chain computations to be proven and mathematically verified natively back on layer 1. To manage hardware strain, proofs operate on a strict scale. A standard RISC-0 Groth16 proof requires 140 script units, while a complex succinct Stark proof demands 740 script units. Assigning a precise unit cost to cryptographic verification guarantees that node operators are compensated exactly for the energy they expend, preventing malicious actors from exhausting computational resources during block validation. The final architectural requirement for off-chain execution is KIP 21, or partitioned sequencing. As we see in this diagram, partition sequencing establishes parallel dividers, separating incoming transactions into distinct isolated lanes of data flow. Without these lanes, a zero-knowledge protocol would have to prove its legitimacy against every single transaction firing across the entire Caspa DAG. By isolating application data, the protocol only proves the state transitions that occur within its specific lane. Marrying off-chain execution with isolated verification lanes drops overhead dramatically. This makes high-volume Layer 2 integrations economically viable without choking the base layer.
Huh. So is it going to get into some information about layer 2 chains launching on Caspa? Because I thought that the cool thing about Caspa that was coming was the ability to run smart contracts on Caspa. Because then all of a sudden that means that you can have true DeFi on Caspa. And I think that Caspa is extremely decentralized too.
Running a stateful covenant engine required Caspa developers to tear out the legacy transaction structure.
Okay, so real quick, covenants. So the UTXO model that Caspa uses, similar model that Bitcoin uses. Bitcoin uses the UTXO model. Bitcoin needs covenants so that you can have smart contracts on the Bitcoin layer 1. In the absence of smart contracts on the Bitcoin layer 1, I don't know what miners are going to do after the next 2 halving cycles. So yeah, but this UTXO smart contract covenant model, quite interesting.
And deploy Transaction Version 1. In Transaction Version 1, the focus shifts to a strict compute budget parameter. To preserve integrity, this data splits into 3 hashing contexts: SIGHASH, TXID, and WTXID. The protocol locks the SIGHASH context, while the compute budget and mass slide dynamically outside it. This strict separation eliminates third-party malleability. It allows node operators to adjust fee parameters on the fly to match real-time mempool congestion, all without invalidating the user's original cryptographic signature. The network calculates the final fee using a revised transaction mass formula. This equation mathematically combines execution script units with a multiplier accounting for physical disk space consumed. By metering data at this granular level, the system forces heavy, complex transactions to pay a premium. The protocol inherently defends itself against state bloat by pricing spam out of existence.
Good.
Building
So that spam part, that's something that I think there's a Bitcoin improvement proposal that is, being argued over right now around exactly that.
The news, I think it was last week.
A lot of similarities between Caspa and Bitcoin here.
Complex logic at this level of the network stack requires writing raw, stack-based opcodes, a process too slow and error-prone for widespread developer adoption. To bridge this gap, developers rely on Silverscript and the Argent frontend, which compile human-readable code directly into optimized Caspa bytecode. For institutional deployments, the Stickting Key Foundation maintains Portrait, an open-source compiler engineered specifically to execute complex enterprise and industrial covenant patterns. Portrait enforces security through the lens crate, which analyzes the semantic model of the entire contract before compilation. It automatically generates verification conditions for value conservation and feeds these mathematical proofs into the Z3 theorem prover for.
Okay, so real quick, these covenants, they are like the smart contract layer on Caspa, but notice how complex this is. It's all about mathematical proofs. That's quite a bit more complex than if you're just writing smart contracts in Solidity for Ethereum or smart contracts in Rust on Solana. So this stuff is, I think, much more complex than, EVM or SVM.
Valuation. If the Z3 solver encounters contradictory logic, it returns an unknown status. The compiler fails closed, halting the process entirely. By integrating formal verification directly into the compiler, the ecosystem neutralizes insecure logic before it can ever be deployed to Layer 1. Caspa operates on a strictly uncompromising monetary policy. The total supply is permanently hard-capped at 28.7 billion CAS, distributed via fair launch with 0 venture capital reserves and 0 founder lockups.
That's good. That's a big positive for Caspa. Now I see what Crypto Steve-O is saying in the chat, that retail doesn't care about this and neither do institutions. I actually think that institutions do care about this. I don't know that retail. Well, I think that if an institution is going to deploy a smart contract or, deploy liquidity or, maybe some RWA asset onto a chain, I think that they really care about understanding the covenants, understanding the smart contract itself. So I think that this is actually quite important to an institution, but it's very difficult to understand. So let's see if we can get a little bit more into maybe some value capture model here for that token.
By mid 2026, the network reached a critical milestone. Over 95.8% of the maximum supply had been successfully mined, leaving roughly 1.2 billion CAS left to enter circulation. The chromatic phase schedule governs this rapid distribution. Instead of multi-year halvings, it reduces rewards smoothly month by month. This continuous decay forces extreme compression. At 10 blocks per second, the reward falls from 2.45 CAS in 2026 to 0.15 CAS by 2030. A front-loaded supply curve inherently alters market behavior. By 2026, the dormant supply metric, representing tokens held for over a year, neared 50%. This locks up liquid exchange float, creating a highly supply inelastic spot market. As the block subsidy rapidly approaches zero, the network faces an existential requirement. To fund the proof-of-work hash rate that secures the ledger, the protocol's economic engine must transition entirely to a fee-driven model.
And that's very similar to what needs to happen for Bitcoin too. Bitcoin needs real transaction volume on that layer one chain, not on the side chains, not on the layer twos. It needs that transaction volume on the layer one. Otherwise, miners will be disincentivized to keep their machines running. They need an incentivization mechanism to keep their machines running and continue to secure the network. Same thing here with Caspa.
It is critical to clarify exactly how the Caspa protocol functions economically. The network offers absolutely zero native staking yields and zero passive fee-sharing dividends for token holders. Caspa is a pure proof-of-work protocol. Every single transaction fee is directed exclusively to the miners, who expend the physical computational energy required to secure the network. In a traditional linear blockchain, the end of block subsidies creates systemic risk. To maintain a security budget on a slow network, miners must extract extremely high individual transaction fees.
And so this is the death spiral for a lot of chains, because once those block subsidies run out, then you can't pay miners and validators to secure the network any longer. And then the chain goes bye-bye.
If volume drops, the security budget collapses, leaving the chain vulnerable to reorganization attacks.
Right.
Caspa resolves this vulnerability organically. These sweeping digital traffic lanes illustrate how the block DAG's parallel production expands total transactional capacity across every consensus round. Rather than extracting high individual fees to survive, the network leverages high-frequency sequencing to process massive aggregate volume. Thousands of low-fee transactions combine to fund the security budget without penalizing individual users. The Toccata architecture guarantees the continuous demand needed to fuel this volume. Every native KRC20 token execution, every ZK rollup proof, and every enterprise layer 2 settlement requires CAS to be metered and burned as utility gas. Toccata operates as an economic necessity for the Caspa network. It ensures the chain's programmable utility perpetually funds the security of the base layer, long after the last Caspa is mined.
But only if there is significant transaction volume on that layer one. That's the only way that this continues to function. And there are so many similarities there between Caspa and Bitcoin that I think that if you understand Caspa, you'd also be able to understand Bitcoin. So yeah, what did Crypto Stevo say here in the chat?
Oh, he said, I need to play this video when I'm trying to fall asleep at night.
Look, man, I mean, this mathematical proof of work stuff is extremely complex. It really is.
And it's true. I mean, there's not a whole lot that's sexy about, a lot of the, details of a lot of these projects. I mean, a lot of it is very dry. And if it's not something you're passionate about, if it's not something you're invested in, it's really, really hard to be able to, go out and spend hours, digging up, this information. So, having an 8-minute video that boils it down for you has massive value, if you're falling asleep on an 8-minute video, Steve-O, you know, how excited or how focused are you if, and everyone out there, if you're having to go find all this manually yourself, online. So that's why these deep dives are so valuable. Is like I said, 15 minutes total. You watch the video, read through the material, maybe check out some of the cited sources, and from that, you should have a pretty good idea if there's any there on the project. If it's interesting enough that you want to dedicate more time to it. That's what these deep dives are for. They're not meant to be, all in capture a full capture of the project and for you to invest based off. They are a Cliff's Notes of these projects. And if you find them interesting, if you like the tokenomics, if you like the adoption that's happening, if you like whatever it is you invest off of. Again, we're not here to influence. We're here to educate. Whatever it is that you invest off of, this is going to give you a little tasty taste. It's going to give you a little appetizer, and then based off of that, you can go and do deeper dives, and you can use the cited sources that we provide to, read deeper. That's what these are for. But really quick, we do have some breaking news before we get into the next one, or kind of decompile that CASPA one. So Senator Loomis posted that I want to thank my Democratic colleagues for their important contributions to this draft and express my commitment to reaching a deal in the coming days that will allow this legislation to become law. Consumer protection and pro-innovation policy aren't opposites. This bill proves it. So it looks like there might have been, some progress when it comes to the Clarity Act. If we're bullish on that or not is a whole nother story, but just wanted to share that.
So, Mike, what is the show me state? Is that Missouri? The show me state?
I that's where I was born. Yeah, Missouri.
Missouri. Yeah, the show me state. So look, I'll believe it when I see it. Show me.
Exactly.
Prove
exactly.
it.
Well,
verify,
dude, that's
don't
why
trust.
I don't know. I doubt it's just because I was born there, but I'm a strong believer in show me. If you don't show me, it's an opinion. That's how I deal with everything. You can tell me something, but until you show me,
you got to prove it, man. You need some evidence. And for that Clarity Act, I mean, look, for how many times have we seen, oh yeah, it's going to get passed tomorrow or next week or next month, and then nothing ever happens. So yeah, I would love to see some progress on that, because I want to read the language. I want to read the language in that bill. I want to see just how badly we're going to get screwed as retail.
Yeah.
Yeah. So what I've got brought up here on the screen, Mike, is Caspalytics. So for this CASPA protocol, I recall trying to use the smart contract layer on here and couldn't figure out how to do it a couple of months ago. So now we've got this Caspalytics.com, this website here. What are we looking at? So here's some information about market. So market cap, $781 million, 24-hour volume, only $7 million. Okay. Network, DAA score, not quite sure what that is, but I think that in the deep dive research that we just watched through, it was describing the DAA score at a particular block height. There was some hard fork. I believe the hard fork was called Toccata. Was that the name of the hard fork? Okay. Circulating supply. Got it. Let's see. Mempool entries, difficulty, hash rate. So all of these terms here, very similar to what you would see for Bitcoin, for the Bitcoin layer one. You got transactions per hour. Okay. So it looks like thousands of transactions per hour. All right. That's good. And so when I see transactions per hour, that makes me think micro transactions per hour. No, unique. Okay. Unique transactions per hour. Got it. Very cool. And it looks like it excludes Coinbase transactions. I wonder why that is. All right. Unique count. Okay. Unique TPS. Wow. Only 0.81. That's pretty slow. Okay. So what can we actually do with this protocol though? Covenant transactions. So I believe this is like the smart contract layer on CASPA. So what are we looking at here? Takata hard fork activated. Okay, the Takata hard fork is active on Caspa mainnet. Covenant and introspection metrics are now live. Got it? So it says this chart tracks the number of accepted transactions that create at least one covenant-bound output each day. So look, when I first moved down here to South Florida, I was a part of an in-person Bitcoin group. And there were a couple of Bitcoin, like legitimate Bitcoin developers in that group. And when they would describe what they do working on Bitcoin, it's all math, man. It's all this really complex math, which is quite a bit different than what you would see on, an EVM or SVM chain. So in Caspa, it's similar to Bitcoin a little bit. So let's see here, supply distribution table. Let's take a look at this. So it looks like 54 million addresses have a very, very, very small Caspa balance. And then for whales, it looks like there's one address with a significant Caspa balance of between 1 and 10 billion tokens. Wow. And then you've got a couple of other really, really large wallets here. It wouldn't surprise me to learn that those really large wallets were, some of those miners from back in the day. So that's pretty interesting. Exchange holdings. Okay. So where is this held? This chart tracks the total CAS held across all known exchange addresses over time. Okay, got it. And it says it's maintained by cas.fyi and caspa.stream. Okay, this is caspa.stream. This looks like the Caspa Explorer. All right. So it looks like very few public nodes, actually. I didn't realize that there were so few, only 522. And transactions per second here, it's telling us 11. So look, very slow, very slow. 172 miners, hash rate, 319 petahash per second. All righty, address is active. Okay, in the last hour, 530 addresses active. So this doesn't look like a very active chain to me. Let's see here, transactions in the last hour, it's saying 31,000 transactions. So we're getting, data here that is actually quite a bit different than that last site that we were looking at, Caspalytics. Okay, transactions, blocks, all right. But what can you actually do with this protocol? Is there anything that you can actually do with this?
More importantly, what's being done?
Yeah, I'm just trying to figure out, why, what's the point? What's the point for this thing? Why would you hold Caspa? What can you do with it? How can you earn yield with it?
Steve-O says the 17 active miners in their mom's basement would disagree with you, David.
I mean, look, if you're an active miner mining and validating the Caspa chain, the Caspa network, then you're earning CAS, I'm sure. But what can you actually do with that? Are there right? What? Send it to an exchange and sell it for dollars?
Yeah.
Is that what you can do with it? So yeah, this okay. Explore blocks, transactions, addresses, analytics.
For whatever reason, I would be interested to hear what their bull case is for Caspa. There's a lot of creators out there that I consistently see posting bullish content on Caspa that they're very bullish on it, and I would maybe on Friday's crypto trenches, maybe we need to go through some of the the bullish Caspa videos and fact check them, find out what it is that they're saying, and we won't pregame or anything like that. We'll just play their videos and and we'll just kind of go through and see if there's supporting facts, supporting data that supports their bullish take.
Yeah, I'm still trying to figure out what you can do with this thing.
You can mine it and sell it is pretty much what the gist that I got.
Yeah, me too. So this, I can't figure out the there. It just looks like a really, really complicated pet rock.
We're gonna on Friday on Crypto Trenches. Friday night we're gonna I'm gonna the three of us, me, you, and Jeff. We'll go through some different content creators. We'll find some information, some sound bites, some clips of them making their bullish case for Caspa, and we're gonna fact check them. And if they're right, they're right. If they're wrong, they're wrong. But we're gonna keep doing that. On Tuesdays and Thursday evenings, we're gonna part of the show is gonna be fact checking content creators, and if they watch it and they feel free to do the same to us. Keep bring us to task. Make sure that what we're saying is factual. That there's that we're citing our sources. That it's supported by facts and data.
Yeah, so I mean, look, I wish all Caspa holders the best. Okay, I really do. Yeah, and just taking a look at the token price here, if we just measure from the August 2024 highs, that was basically like part of the peak of the last bull. In August 2024, we also got that first unwind of that Japanese yen carry trade, and so there was a bit of a flash crash, not just in digital asset markets, but also in TradFi too. So if we just measure from that peak down to, that's the October 10th low, that's a negative 95% for CAS. So yeah, just trying to figure out what this thing does was kind of difficult, and trying to figure out what it could do, also quite difficult. So there's a couple of levels of resistance on the upside here for CAS. The first one comes in at that 200-day moving average at 0.034, so 3.4 cents. It's currently trading for 2.8 cents. So yeah, this thing not looking too good, and difficult to define any value capture model there. Difficult to see what you can actually do with those covenant smart contracts. So yeah, I'm gonna have to pass on Caspa, and that's a shame because I used to like it. And I liked it just because, I don't know, I saw it on YouTube. It's not a good reason to like it, guys. That is not a good reason. So yeah, this one definitely does not meet our trifecta. Let's put it that way.
Yeah.
So
and the reason that I want to do that on Friday is because I see a lot of content. Just like with XRP. I see a lot of content and people hyping this project for views. And, so I really want to understand, are they actually bullish on it? Or are they just creating content because it gets views? Because that's really what I've noticed with a lot of content creators, a lot of, influencers. It's why I like to point out we're not influencers. But they tend to post content on whatever is going to get the most attention, the most eyeballs, because that's how they get subscribers. People love to hear bullish things about the projects they're invested in. People do not want to hear, things that are go against their bullish thesis on their investments. And like David talked about earlier, we need to be more critical of the assets that we're invested in than the ones we're not. We need to be seeking out. There's no there's no shortage of bullish content on a lot of these assets. Swing a dead cat, you're going to hit somebody talking bullish about your project on YouTube, or on X. If you put in the cash tag, for your asset, you're going to get a bunch of people talking bullish about it because they know that's what's going to get them followers. You go on YouTube and you search, Caspa or XRP, you're going to get the top views, and that's what YouTube is going to, the algorithm is going to push you to, are the ones that are getting the eyeballs, the ones that are getting the engagement. And so you're going to get, the bullish content is what rises to the top. You need to actively search out people that are critical, both show the positive and the negative on all of these projects. And that's what we do here. That's our motivation.
Have we run deep dive research on XRP yet?
We have.
Let me see if I can
It was a while ago.
Let me see if I can find that. XRP. So we ran it on Ripple and XRP to know the difference. I think it might be valuable just to run it on the XRP coin. That could be valuable because I see what Moneymaker XRP is saying in the chat. And look, we welcome comments like this. And look, Moneymaker XRP, it's okay to be wrong, man. It's okay. You got to seek truth, brother. But you're saying SRP has been in the works for 25 years, created by central banks to solve the world reserve currency problem. That's retarded, bro.
Well,
come on.
It's 100% false. So it has not been developed for 25 years. And the banks, the central banks, it was not created by central banks. So the way that Ripple got it is it was developed, and all of the XRP that they have in escrow was gifted to them. And so that is what they're using to fund their operations currently, because they're not making enough money to fund their operations. Medico and all of these acquisitions they've done, the money has come from selling XRP, out of that escrow, that monthly unlock of 1 billion tokens. The way that they're paying for that office in New York and San Francisco and all the other offices around the world, that is coming from selling XRP. They are using you as liquidity to fund their business. Most of the business that they do, we've shown this with data, most of the business that they do and the revenue they generate goes directly to Ripple. None of it goes to the XRPL or the XRP token. The money that they're making is like 80% of it is going to Ripple, the company. And XRP, the court case with Judge Torres, the SEC versus Ripple, she ruled that XRP is not a security. Therefore, holding the XRP token gives you no claim on the revenue that's generated by Ripple, the company. And the token lacks all value capture other than it being a gas token. So even the transactions that happen on the XRPL, it would take over 10,000 years for 10% of the XRP supply to get burned. I did the math. At max TPS, it would take like 5 to 10,000 years for 10% of the supply to be burned. I don't know about you, but I'm not a vampire, so I'm not.
I know, right? 10,000 years, man. Oh yeah. So let's see here. Let's bring it on back to the deep dive. I know. I saw that. I saw that comment too, Mike. Yeah.
We might have to go down this rabbit hole with Moneymaker sometime because it's not a federal agency. If it was a federal agency, we can go through, and I don't want to waste a bunch of time on this. We need to do this deep dive, but there is a lot of things that factually prove that not to be the case. But we'll save that for another time.
Okay, so Lorenzo protocol and VE tokenomics. Let's learn about this thing.
The native Bitcoin network holds over $1 trillion in capital, yet its rigid architecture locks that value inside an isolated, non-programmable system. Simultaneously, the decentralized finance landscape is shifting from speculative yield farming towards structured, risk-aware financial engineering. Institutional capital is limited here because the native Bitcoin network lacks smart contract functionality, preventing its assets from entering programmable yield ecosystems. The Lorenzo protocol operates as a decentralized asset management and banking layer engineered specifically to bridge this gap.
Okay, so there are a lot of these types of protocols now.
Yes.
It's not just Lorenzo. There's a bunch of them.
It uses a financial abstraction layer, or FAL, to package complex cross-chain execution into standardized, tradable, on-chain traded funds. To understand the mechanics, we have to trace a deposit through this FAL, analyze the funds it outputs, and map how its V-Bank token captures value. Solving this integration allows Bitcoin to function as active, programmable collateral, bridging the gap between its native network and modern finance. This flowchart models the financial abstraction layer, the protocol's backend engine designed to isolate depositors from execution friction. As capital enters, it automates routing and settlements. The FAL conducts real-time net asset value calculations, routing capital into single, multi, and structured strategy vault tiers. Because some sophisticated strategies are too complex for pure on-chain environments, the protocol utilizes a hybrid model, executing capital deployments through off-chain CeFi custody partners when necessary. Modularizing the architecture this way allows institutional strategy providers to launch new funds instantly, bypassing the need to rewrite or audit core smart contracts. This diagram maps the exact cryptographic lifecycle of a native Bitcoin deposit. First, the depositor transfers native Bitcoin to a multi-signature address on the Bitcoin network. Lorenzo's monitoring modules scan the mempool to verify confirmation blocks. Once finalized, a signin fires to the Cosmos app chain for validation. In response, the native Cosmos module mints a liquid representative token, STBTC, routing it directly to the user's wallet. Back on the native Bitcoin network, the underlying asset is locked into the Babylon security time lock. Finally, algorithmic yield generation begins as that delegated Bitcoin secures active validation services across multiple proof-of-stake networks.
Okay, so AVS, this is what you see with EigenLayer, on EVM chains. Now, it's talking about some native yield here. I'd be willing to bet that that native yield is less than 1%.
The cross-chain execution is cryptographically dense, but the FAL abstracts this friction. The user makes a simple deposit and receives a liquid, composable asset. This model shows on-chain traded funds generated by the FAL. Through a partnership with World Liberty Financial, Lorenzo produces a stablecoin suite targeting payment applications and DeFi integration. On the left is USD1 Plus, an automated rebasing token. The unit price remains at exactly $1, while the physical token balance in a user's wallet automatically increases as yield is captured. Standard.
Okay, so World Liberty Financial, that is the Trump family product or business, I guess you could say. Now, they do have a legit stablecoin product, this USD1 stablecoin product, but the WLFI token is a really shitty governance token. So although there's a legitimate stablecoin product, that governance token, not so much.
DeFi lending protocols cannot process these shifting rebasing mechanics, requiring a different structural approach. For these environments, the protocol outputs SUSD1+. The token supply in the wallet remains static, but the accrued yield drives up the net asset value, increasing the token's redemption price over time. We see a similar bifurcation in Lorenzo's Bitcoin-denominated liquid staking suite. The asset STBTC directly accrues staking returns from the network secured by the Babylon protocol. Alternatively, EnzoBTC functions as a decentralized one-to-one wrapped Bitcoin designed for high-velocity liquidity provisioning across EVM networks. Modularizing these funds is necessary because different institutional sectors, from payment applications to automated market makers, require mathematically incompatible token behaviors to function. This funnel diagram tracks the yield generated by these funds back into the protocol. The gross yield drops through layer 1, where a variable percentage is stripped to compensate external active strategy executors. The remainder falls to layer 2. Here, the core infrastructure taxes the flow for NAV calculation and risk monitoring, settling this service fee directly into the Lorenzo treasury. The final balance represents the net yield. This passes directly to the depositor through token price growth or supply rebasing. To participate in the revenue sharing of layer 2, token holders lock their bank tokens into a time-weighted voting escrow contract to mint VBank. These VBank holders utilize a gauge voting mechanic to direct liquidity and yield boosts towards specific vaults, optimizing the volume of layer 2 fees generated. This cascading extraction, combined with long-term governance locks, insulates the token from the high inflation issues that affected earlier DeFi models. This macro view maps the protocol architecture as a closed-loop system, from deposit to execution, cycling back through the fee funnel to the treasury. To absorb shocks, the treasury diversifies these revenues, accumulating stablecoins and native Bitcoin, avoiding reliance on holding its native bank token. Concurrently, the protocol executes a deflationary buyback program, deploying a portion of treasury revenue to systematically purchase bank tokens from the open market. Traditional spot finance vehicles offer lower management fees, but they lack the staking yield and algorithmic composability found in on-chain assets. The Lorenzo protocol abstracts the technical friction of cross-chain execution into a single seamless layer. By integrating Bitcoin into a mathematically rigorous, non-inflationary financial machine, the protocol increases the asset's utility as active capital within the broader ecosystem.
So why exactly did the bank token pump recently again? I didn't quite get that from that piece of deep dive research, but
I didn't either. I was curious, but yeah, I didn't.
yeah. So bank, we're looking for bank. Yeah. So I think it's this one, bank USDT. Yeah, this is the one. So this looks like it is the reward token for that Lorenzo protocol. Um, yeah, I can't quite tell why this thing would have pumped. So let's take a look at the Lorenzo protocol itself over on DeFi Llama. Here it is, Lorenzo protocol. So 560 million TVL, that's a lot actually. And TVL up and to the right, even during a bear market, that's pretty good. Moving sideways during the bear, not bad. Take a look at revenue annualized. Okay, 157K, very, very small. If as we scroll down here, let's look at the income statement. So the income statement says that this protocol has generated positive earnings, but very, very small. So we're talking about, measured in the thousands or tens of thousands of dollars. So this thing does not seem to generate a whole lot of revenue. Let's see if we can take a look at the actual website for Lorenzo. Looks like it is lorenzo-protocol.xyz. So it seems as though maybe that bank token could have pumped as a result of some integration with World Liberty Financial. So, we talk about speculative price moves all the time. And, in the absence of any real value capture model, it's difficult to figure out, okay, why did the token price move to the upside? But for Lorenzo, with that bank token, it looks to me like it could have made that big move to the upside simply as a result of an announcement of an integration with World Liberty Financial and that USD1 product. So earn yield on your USD1, it says. You got staked USD1. This is advanced USD1 yield launched after the Lorenzo Innovative OTF product model. Okay, great. You can earn 1.35%. Like, what's the point? Why would you want to take on all this risk? You've got smart contract risk. You've got counterparty risk. Why would you want to take on that risk and only be rewarded to the tune of 1.35% APY? Like, make that make sense.
Yeah.
You could just buy treasuries and earn more. Or you could just take your liquidity, deposit it into a vault on, a money market like Morpho and earn 4%. So, yeah, I don't know why are people attracted to this?
You could just invest in U.S. Treasuries and just earn a stable yield,
right?
At a 4 or 5% return. I mean, it's a lot less risk.
Yeah, I'm just trying to figure out what's the point of using this advanced USD1 yield optimization. Alrighty, multi-protocol.
This goes to show you, not to say that there isn't anything here. We're just not seeing it in our deep dive. But this goes to show you. You can still benefit and profit from speculative pumps in crypto. I want to keep emphasizing this. We're not saying that you can't make money in a speculative market. What we're saying is if you have a long-term mindset, you need to shift your thinking.
Yeah, I'm just trying to figure out the value in the bank token, and why hold the bank token? Can't figure it out. Difficult to figure out why you would want to operate within this ecosystem. So if I take a look over here at Lorenzo-protocol.xyz and we look at that vote escrow bank, so this is where you would take your bank tokens and it looks like lock them for a period of time between 1 week and 4 years. That's that vote escrow VE33 model. Okay, great. So you lock it for what purpose? What type of yield are you going to be able to generate as a result of locking this thing?
You lock it so you can't sell it when they dump it.
That's kind of what I'm getting from all this, Mike.
Yeah. Well, if I remember right, it has a connection to World Liberty Fi, which I'm not a fan of.
Me neither. Me neither.
As much as I like a lot of the stuff that Trump does. One thing that I adamantly will very vocally say over and over again, I think it is a very, very bad look for a president elect and president now, where he launched a meme coin and that he launched World Liberty Fi, and he's leveraging his position to profit. And I think that is a very, very bad look.
It's horrible. It's absolutely horrible. And don't get me wrong, I really love a lot of the things that President Trump has been able to accomplish and is working to continue to do. But dude, like, you can't launch a meme coin. Like, you can't be the president of the United States and launch a meme coin, bro. Like, that's not good. You can't do that.
Yeah.
And I mean, look, this thing has done nothing but down only. Like, this is horrible.
Yeah.
So yeah, and I think Melania, that was another one. Melania launched the same day.
Right after Trump, made all the money, then all the liquidity as the Trump coin was dumping, Melania was pumping. And then I think that there was even a Baron, like a Baron
I
token.
think there was too. Yeah.
I never tracked it, never heard a whole lot about it. I think after people got burned by the Trump token and the Melania token, they were like, and I'm done.
Yeah, so it looks like these data go back to Monday, January 20th of 2025. And then if we take a look at the Trump token real quick, it looks like these data go back to, it should be the same day. So these data go back to, it looks like, so basically the 19th and the 20th of January in 2025. Now, what happened to Solana on that same day? Right? If we take a look at Solana, didn't that mark the top? I'm pretty sure that could have marked the top.
Oh, I'm sure.
So it did. It did.
Massive volume.
Yeah, right there. So that actually marked the top for Solana when Trump launched his meme coin. Dude, it was crazy.
Solana don't.
That was so crazy on that day, man. So he launched it on a Friday. And then that next morning,
billions liquidity got sucked out of everybody, rushed into that token. And as they did, all of the insiders, Trump included, were selling.
Yeah, he made $500 million dumping that token on retail over that weekend. And that was right before his inauguration.
Well,
so
and like I said, we call it as it is here. I voted for Trump. Yeah, out of the options that we had, he was the clear choice. But we're going to call it like we see it. And what he did with that token it's not criminal, but it is highly scammy. We'll very, very scammy. We'll put it that way.
Yeah, you're not kidding, man. That very, very scammy.
So real quick, I want to address this because this is something I see quite a bit. Where's it at? Here, let's go over to here. Oh, here we go. So Moneymaker, XRP. I brought up Canton, but Canton isn't just for tokenization. Canton is the interoperability layer, or the network that siloed networks are building on. The DTCC, JP Morgan Chase, major banks and institutions that have actively launched and are actually using it. That is the key here. So Canton is not just for tokenization. And as far as a bridge asset, you brought up the BIS, and let's see if I can find it. Anyway, you brought up the BIS and that that supposedly, oh, here we go. it just hasn't been officially announced. The BIS and IMF have been working on this problem since before BTC or XRP. You can't create a bridge currency without working with or from government agencies. So this is a narrative that I've seen in in the XRP army, where the BIS is going to use the XRPL and XRP and all of that. That is not the case. They actually spearheaded and launched. It's called WCBDC. It's basically a stable coin. And that is what they are actively using and plan on using to be the cross-border liquidity. And it has atomic settlement. There's no need for a bridge currency if you have atomic settlement. So, we can pick apart all of the, and we pick apart all of the XRP narratives because they're all hype. They're all buzzwords. They use, what is that? When people use like titles and
a call to authority.
Call to authority. Thank you. They love using calls to authority. The BIS. They love throwing out SWIFT and all these big organizations, and then they'll try to craft this very detailed hypothesis on how XRP and the XRPL is going to play into it. And if you watch a lot of the content out there, and from through that lens, it becomes very obvious. They use a lot of emotion, a lot of calls to authority, and then they pepper in ifs and when but they never have anything solid. They never have anything that where any of these, because I've listened to these narratives for like 5-6 years since I got into crypto, and not one of them has come to fruition. Not a single one that these XRP shills talk about. Not a single one of their hypotheses has come to fruition. Other than the SEC versus Ripple court case. That's it. And nothing happened to the token price. We were supposed to go to the moon when that, we got that judgment, and nothing happened. So
yeah. So I think what we need to do, Mike, is coin a new term: Fugazi coin.
Yeah.
I think that, Fugazi token, Fugazi coin, XRP, no value capture. So even if any of these things, insert name of institution here, partners with XRP, Ripple, whatever, even if any of those things came to pass, why does that matter to you as a token holder? If there's no value capture, why would it even matter if there's some partnership with an institution? If there's no value capture, what's the point? So how do you benefit as an XRP token holder? If holding XRP meant that you had a contractual claim on the revenues generated by Ripple Labs, that's a whole different ballgame, man. But you don't. It's not a security. It's just a Fugazi coin. So if you've got no claim to the cash flows being generated by Ripple Labs, then what exactly are you holding? I think it's more like a meme. I think it's just a really cheap gas token.
You're buying the XRP community.
Yeah, basically. That's what you're doing. You're buying into that hype. It's mind share that drives that token. And I mean, look, it's available on every centralized exchange. So that's a big deal, right? But that doesn't make it good. Just because you can buy a bag of dog shit at a lot of places doesn't mean that that's good.
Well, you can find it for free, dog shit for free in a lot of places. But it's so important that you understand these aspects. And again, it doesn't mean you can't make money on XRP. You just need to understand what you're investing in. You're investing in the community. You're investing in the hype. And if you're taking profits and you're trading that hype and that volatility, absolutely, you can make a ton. I know a lot of people that have made a ton of money off trading the volatility and the hype on XRP, but they're smart enough to bank those profits and invest in real projects. So you just need to understand that.
Yeah, I mean, I've got the chart of XRP brought up here, and so we should start to see the final leg down for Bitcoin in the coming weeks and months. Maybe over the next 8 weeks, we should see that final leg down for Bitcoin, this bear cycle. And if or when that happens, I think that XRP is going to have another leg down too. So if we're just going to measure from the all-time high here, XRP is down roughly 73% from peak to trough. If I just go ahead and remove that drawn object and zoom out a little ways here, I think that XRP has some solid support this bear cycle around 75 cents or so. So that horizontal looks like a solid level of support for XRP. Now, it does have a level of trend line resistance right about right here, or we could draw that in by using the highs from January of this year as the anchor point, and then we would connect to the next lower high. And if we zoom in there, well, you can actually see that XRP has broken out. So could this thing rally? Yeah, it definitely could. And where would you expect there to be some resistance on the upside? Well, a big level of resistance would come in at that 200-day moving average, which right now is at $1.41. So if XRP continues to rally and rallies all the way up to that 200-day moving average, that's plus 25%. So can you make money trading XRP? Absolutely you can. It's got a huge holder base.
Yeah.
But is it a Fugazi coin? I think it is.
And I agree with David 100%. It's just that you just need to understand what it is that you're investing in and adjust your thesis, adjust your
expectations. I mean,
well, just kind of how you invest in it. So, a lot of the stuff that I invest in, I'm a long-term investor. I'm looking for the next Google, the next Microsoft. That's because I'm not a trader. If you're a trader, XRP is probably one of the best ones you can invest in.
A lot of volatility.
A lot of volatility. There's a lot of volume. A lot of those things. So it's great for traders. Just like Bitcoin. But I'm not a trader. I don't possess that skill set. So I'm looking for long-term investment. I'm looking for value capture. I'm looking for things that I can use in DeFi to earn yield. That I can borrow against the asset. Things like that. So my 2 cents on my closing thoughts on this. Both of these that we did a deep dive on, I've got to say that.
What type of grade? What grade would you give these, Mike? The Lorenzo protocol and Caspa. What grade do you want to give these things?
I would give, as far as from me, a long-term investor, Caspa, I would give like a C- or a D+.
I agree.
Yeah, Lorenzo. Again, just from a long-term investor mindset, I didn't see anything that made me want to run out and buy any. You got to respect the pump that it had, but I think if you weren't in it before that, you missed the boat. If you jump in it now, potentially, you're going to be exit liquidity for people that bought it at a much lower price.
Yeah. So, what do you think for the protocol? Because I just gave Caspa a node grade of D.
Okay. I would say, because there's still a lot of unknowns and it's still very new, I'll give it a C.
A C. Yeah, I think that's fair. Definitely. So I'm going to give it a grade of C also. I agree with that. And let's see here. What type of protocol is it? I'm going to say stablecoins and restaking. That's what I'm going to mark this as an update item. There we go. So it looks like, according to us at the node, Lorenzo protocol gets a grade of C, and Caspa, unfortunately, gets a grade of D.
You know what? I need to freaking run this weekend. I need to do it. We did a deep dive, Scotty, on EtherFi, but it was before we had the deep dive library, because I remember doing it, but it's not in there. So I'll have to rerun that this weekend.
That'll be interesting. I like EtherFi.
Yeah, no, I know. I know that you love it, but and like I said, I know that we did a deep dive on it. It was just before we had the deep dive library, so we'll have to jump into that one. Well, that's all the time we got for today. Appreciate you all in the chat. Love how engaged you all were. the comments and the questions and the back and forth. Again, Moneymaker, thank you so much for your input. We love, when people have different views on things here. It forces us to more deeply examine, our views, on these assets, because, every once in a while, I have people from, the XRP Army or, other places that will ask a question and I don't know the answer. And so it makes me have to go and dig, and see, hey, has something changed since I look at that? It has some announcement come out that I missed. And so it forces us to stay more up to speed with, our knowledge on these assets and these projects. So thank you so much. I just want to give you a shout out.
Appreciate all of you guys. Thanks so much for showing up, and see you again tomorrow.
All right. And we'll see you. Till next time, Veteran Crypto out.
Peace.